This one working? Yeah, okay. So thanks everybody for joining us, and thanks everybody online for logging in early this morning, and I think it was -17 and frosty and foggy here in Calgary. I'm just first going to take a couple minutes to introduce my colleagues here. We have Namir Hallak, who is our U.S. business tax lead within Andersen. Atif Mir is Canadian business tax within our director of our Canadian business tax group. And then Shondell is a director within our enterprise advising, as well as many other hats the gentleman wears. We're just going to take a bit here to start off. They're just going to give a 5-minute summary, high level, before we get into more of a panel discussion on different areas to contemplate when you're expanding into the United States and or back into Canada, if you're having investors into Canada, things that they might want to contemplate, because there is, contrary to some popular belief, there is actually a lot of capital coming into Canada, and we field a lot of questions from U.S. companies investing money into Alberta entities right now. So we'll be going through that briefly, and then we will also take questions. So I want this to be as open forum as possible. So if something comes up, please feel free to interrupt us and ask a question. We will leave time at the end for questions and answers, but if I'm a big fan of, if something's on the top of your head, if you don't ask it, you're probably going to forget it. So just raise your hand and we'll make sure that we ask your questions. And I'm assuming, I don't know, Krista, online, if they can type their questions into there, and then it'll be moderated if that's possible. If not, just email us. Okay. So first we're going to kick off here with, I think, Shondell, you're up first.
Well, my name is Shondell Sabad. Like Krista said, I'm with Andersen Tax on the enterprise side. And what we really do, or what our group does, is work with these folks here to, provide enterprise solutions. And that could be anything from, we're looking for location, or, we're looking at making an investment, or we're looking at divesting. And then we lean very heavily on our colleagues at Andersen to make some of those things happen. So I think really all I want to do, we're going to hit the high notes here, and there's going to be a lot of questions. So once we get to the question and answer, please feel free to dive deeper into some of these topics. But I'm going to do a very high level about, going to the U.S. or vice versa. So first and foremost, you really do have to think about, why do we want to do this? Obviously this week there's a lot of obvious reasons for doing it, but some of the other things that you might want to think about, obviously growth opportunities. I want to be closer to my market, closer to my customers. And then one of the other ones, obviously, is the cost savings. Depending on who your customers are and the cost structure of your business, there may be certain advantages to either relocating into the U.S. or relocating into Canada. Some of the more not obvious reasons might be supply chain advantages. I could be closer to my raw materials. I could be closer to, some kind of export capacity. Some of those things might come into play when you're making these types of decisions. And obviously, one of the ones that a lot of people might not think about initially is the regulatory environment. Is it easier to do business in this new location? Can they clear the path for me? I don't think it's any secret that a lot of people relocate to Texas, the regulatory environment being one of them. And then, of course, these folks here will talk about taxation. We will talk about the U.S. election and some of the challenges that is bringing up. Obviously, I think that'll be a lot of the questions, but tariffs being another one. Then we want to examine where. I think historically people have made that decision. All my competitors are in Texas, or I like Houston, or I really like to be in Phoenix. But you want to go beyond that. You want to balance your excitement with some hard facts. So use a decision-making tool. Talk to as many experts as you can about this decision, and make your decision based on that. So again, the obvious ones are market size. U.S. is a bigger market than Canada, but it's also more competitive. Regulatory environment we talked about, infrastructure and logistics. Those would be some of the questions you want to answer with respect to, where do I want to locate. Some of the not so obvious ones are, is it a cultural fit? Do my employees or the people, I might want to move to that location, do they want to live there? Do they want to raise their families there? And then also talent. Can I get the talent in the location that I'm looking at? Lastly, again, skimming the mountaintops here. How do we do this? I think experience probably tells us that the more people you can talk to and the more experts you can engage will really help in your decision making. And having a team of Andersen people at your side is definitely going to help you reduce the risk. You want to do some strategic planning, obviously. That's something that we can help you with here. Tax planning for sure. Having looked at this before in some of my businesses, to say that it's complicated is an understatement. Regulatory compliance, you want to make sure you're navigating that properly. And then, supply chain and trade associations, things like that. Then you want to make an objective decision. Look at alternatives, perhaps implement a little bit of red team mentality, which is get a group, whether it's an external group or an internal group, and ask the question, why shouldn't we do this? Or if we really screw this up, where do we think it can go wrong? So again, I'll end on that note, and I think really there are a couple of key takeaways. Obviously, having a team of experts and engaging early in the process. So before I finish, what are some of the industries that might want to look at moving south? Because obviously, depending on your business, the obvious one is if you manufacture something and you sell it into the U.S., you're probably going to have to go through this exercise. Donald Trump has made that very clear, and he's not doing it to be punitive. He's doing it because if you're making something and selling it to a U.S. consumer, he wants you to make it there. It's really that simple. Energy and oil field services, that's an obvious one. They're implementing a strategy, drill, baby, drill, which is, very encouraging for lots of people in that industry. So a move south might make some sense. Tech and software, obviously places like Silicon Valley and Austin offer access to capital as well as talent, and manufacturing. We've talked about that. But Canada does hold a lot of advantages. And I think some of the industries that might want to look to move here are renewables and energy sustainability businesses. We are the best in the world when it comes to carbon capture. So for a lot of companies, being at the center of that would matter a lot. Secondly, agriculture and agribusiness. Alberta does have abundant energy. So businesses like indoor vertical farming would thrive here in Alberta. And then, of course, technology and AI. The environment here in Alberta is giving tech companies access to talent and a better cost of living for the employees that they hire. So on that note, I'm going to turn it over. Thank you very much.
Awesome, thanks, Shondell. And as I said, we'll go into a panel after this. This is just hitting the 50,000 foot to kind of kick off the conversation. And as Shondell said, there's lots of nuances. I was having a conversation over here, and I love an analogy that my partner Namir uses often is when you think about the two countries, although they look very similar, we talk the same languages, a lot of the ways that happen are the same. However, the US is like the NFL and Canada is like the CFL. So although we still both throw a ball, they're completely different in the way that they're played and operated. So if there's an analogy to remember, that's the one I now has stuck with me for the rest of my career. So I'll hand it over to Atif to just briefly highlight the Canadian tax implications.
Thank you, Krista. Good morning, everyone. Thank you, Shondell, for that high-level view. So I'll zoom in a little bit, but still give you a high-level view of the Canadian tax and how it operates. I'm representing CFL today. And so I'll tell you a little bit of the process, how I go with my client when they call me and they say they want to expand into the U.S. First, we get to know their business, we get to know their objectives, learn more about the client, and then we say, okay, are you ready to move to the U.S.? And let's say the client makes frozen burgers. and they have done extremely well in Canada, and now they want to move to the US for more revenues. People in the USA eat bigger burgers, so that's good for revenue. Hopefully the margins will be better, so they want to move to expand their business to the US. Now, if they are just exporting those burgers, frozen burgers to the US, and they are going into the warehouse of different restaurants and fast food chains, and that's all that is happening, then you are not required to do any Canadian, there are no Canadian tax issues there. But your business has expanded, and now you need your own warehouse to be able to provide burgers to different restaurants and fast food chains in the US. Now you have a fixed place of business there, which triggers a permanent establishment, and now you have a branch there. Now you have to do Canadian tax filing, the US tax filing, but I'll let Namir take care of that. And the other thing is, how are you going to expand your business? Is it going to be, what kind of financing? Is it going to be debt or is it going to be equity? Again, Namir will touch upon it from the US perspective. Then once your business has settled down, things are working nicely, then you need to make sure that since you are incorporated, you're meeting your Canadian tax filing obligations. If you own the Canadian US corporation, if you have set up a US corporation, you have expanded from branch to a US corporation. First thing we tell everyone, don't set up an LLC if you're a Canadian corporation in US. But now that you have set up a corporation, you need to file T1134 form. How many of you have heard of T1134 forms? There are a couple. So it's a 9-page document which requires the CRA to know everything about your business. But the most salient or important points, not that other things are not important, is that you have to report FAPI, foreign accrual property income. So think about your business. It has grown, it has expanded, it has become successful, you have tons of cash. You don't know if you want to bring the cash back to Canada or you want to reinvest and expand further in the USA. While you're making that decision, your cash is earning interest income. Now that's FAPI, meaning that CRA does not like the fact that the interest that you were earning in Canada and interest that you were earning in the USA, you should not be paying less tax to the USA. So every year you have an interest income. The Canadian corporation that owns the US corporation has to report that income on its tax return. So that's FAPI. That's something that is critical. One of the other critical things that you have to report on the form is repatriation in the form of dividends. So if you bring the cash back into Canada, how will that be treated in Canada? It could be tax-free or it could be taxable, depending on which pool does it come from. How do you figure out that pool? That pool is calculated from day one when you were incorporated. It's a cumulative concept. Every year you have to calculate that pool. And when the dividend is paid, when you file the T1134 form, you have to show the calculations to say that this dividend should not be taxable in Canada. So that's the repatriation part. Now, most of you here, I'm guessing, are interested in the expansion into the USA, but if some of you online are the USA taxpayers who are thinking of expanding into Canada, the first thing we will figure out with the client is, do they have a permanent establishment in Canada? Should they operate as a branch? Should they operate as a subsidiary? How should the financing be done? Should it be equity? Should it be debt? And one of the other things that's critical is that if you're expanding into Canada by buying a Canadian company, you have to set up a Canadian acquisition company. It can save you a lot of taxes down the road. So that's critical. Some US companies want to set up a ULC because of some tax advantages that arise out of that. And then when the money goes back into Canada, you have to think about the US tax consequences. Now, the important thing is that all this happening, expanding into USA, coming back into Canada, Namir and I are working together to make sure that we are covering all the US and Canadian tax bases and everything is well coordinated. So the high-level takeaway is, when you're expanding into USA, be aware of what's the best structure that will serve you. Financing, how are you going to do that? What are the tax consequences? How do you bring your money back? And are you meeting all your Canadian tax filing obligations? And when you expand into Canada, structure, which equity should you be, which entity should you be using an entity, or should you be operating as a branch? What is the financing here, and what are the tax implications? And when you take the money back, there could be withholding. Now, there could be withholding in other situations as well. For example, a non-resident comes to Canada from the parent company and performs services for the Canadian company, there might be withholding obligations there as well. So be aware of those takeaway high level. There are a lot of intricate things there. It sounds complicated. It is. And, it might be a little bit frustrating in the beginning, but it's far easier to handle these things proactively as opposed to when the CRA calls you.
Awesome. Thanks, Atif. That's good. Yeah, the one thing that I always remember when I'm thinking about expansion one way or another, quite often people just think of the tax implications, and you brought up the T1134. The part that we find is missed majority of the time is actually the foreign reporting. And so both Canada and the US, and actually every country nowadays, if you think about the world that we live in, how much easier it is to cross border with businesses, shipping, like the world is wide open right now. So every country has put in place extensive amounts of reporting to capture monies that is leaving their country and they're not able to tax. Although we think Canada has a crazy regime, we have the United States, who is probably about 100 times more complicated when it comes to foreign reporting, because they literally want to know everything plus your dog's name, pretty much always. And so when we think about it, we talked about the CFL and NFL, and then as we continue down into the US, we have the rugby game, which also throws a ball but is backwards, and that's the different states down in the United States. So you have to think about, there's all these different rules that you have to play into. So I'll pass it over to Namir to talk a little bit about the US before we hop into the panel discussion.
Just going to add one quick thing to that comment as well. One thing you'll hear about, even as a non-tax person, you don't need to know the details, but just enough to know that when you hear OECD Pillar 2, what that talks about, and you hear a lot of tax geeks get really excited about this, is all these jurisdictions, with the exception of the US, are talking about different ways to get really the first dibs on how to tax any company that is, structured in a very fancy way or in a more complex way where potentially they're not getting their first dibs on that tax. And the US is one of the countries that said, hey, you know what, we don't really like this, so we're going to respond in a different way instead of saying we're going to adhere to these Pillar 2 concepts. So the idea of how different countries are going to respond to ways to get first dibs to tax you first, this idea of a global minimum tax, all these different concepts are going to keep coming up more and more. And the US is one of the countries that said, we're not dealing with this yet, but the rest of the world is actually trying to achieve that. All right, so with that quick introduction, so hi everyone. My name is Namir Hallak, U.S. business tax partner at Andersen, and yeah, it's a really exciting time to be specialized in U.S. tax. I enjoy my role of problem solving for businesses that want to expand across the border. And look, I can appreciate for business owners, they're always looking for ways to grow and expand beyond their border. But look, taking your business across that invisible border does require some careful tax planning. For example, if you're going into the U.S., yes, the U.S. tax laws are pretty complex. But the other surprise a lot of Canadian business owners find is when you're dealing with the U.S., you're also dealing with over 11,000 jurisdictions. So not just the federal, the state, but you're also drilling down to the local and county level. So you're dealing with sales tax and use tax. So there is an inherent added complexity when you're going down to the U.S. And there's also, surprise, surprise, some political and tax changes that are coming. And that's going to impact, how are you going to structure your business? What is your site selection? Am I going to keep sending my employees down to the U.S. or from the U.S. up to Alberta? What does that look like? Are they going to be business visitors? Are they going to be secondments? All those different things are going to be impacted by the political and tax changes that are coming. One of the first decisions, though, I would say when clients come to us and say, hey, I'm really excited about expanding to Alberta or expanding to the U.S., is your first decision is, how do you want to structure that business? So, for example, if you're an Alberta company and you want to do business in the U.S., you could say, hey, I'm going to go in the easiest way possible. I don't want to spend a lot of money here. Let's use my Canadian entity. And what that really means is that your Canadian entity is going to get exposed to U.S. taxes. The risk you have with that, though, is you can also risk losing your Canadian Small Business Corporation status, which provides some pretty valuable tax benefits for the Canadian business owners, things like the long-term capital gain exemption. On the other hand, you might say, hey, you know what, I think we actually need to set up a legal U.S. entity, so a U.S. subsidiary or a U.S. legal structure. And that could be more expensive to set up, but again, we're talking tax, but even if you step away from tax, this might be a necessary planning outcome in this new protectionist, Buy American, America First political landscape, where you might actually have to have a U.S. legal entity. But you also need to consider how you want to finance your cross-border business. You can use debt, you can use equity. You need to figure out how you want to value intercompany charges. So if you have related companies that are doing business with each other, that's the world of transfer pricing. And again, if you're sending any of your employees across the border, you have to think about what types of taxes that could trigger, not just for you as the employer, but also for the employee. And so you really have to be mindful of tracking their time in the U.S. and being very intentional about what are you actually doing when you're going down to the U.S. or if you're a U.S. company coming up to Alberta or Canada. And of course, top of mind for business owners, I've set up my business. I'm happy about being a cross-border business. We love being a multinational company. How do I bring those profits back to Alberta? So there are different ways to do that. You can do that with dividends. You can do that with royalties, management fees. All those types of tax considerations, will require you to have some tax planning, review the U.S.-Canada Treaty, and see what are the options available to put you in a tax-efficient structure. Now, of course, I'm not going to end my quick little opener without the big elephant in the room. By the way, the Republicans actually are symbolized with an elephant since the 1800s. Do you know why, by the way? Why they were represented as an elephant? So it was a cartoonist, designed it in the late 1800s, and it's because the elephant represented in the cartoon, they're powerful, they're large, they're steady, and they're determined. That's why the Republicans are often depicted on a cartoon as an elephant. So that's just the big elephant in the room. The Republicans had a big night. They had a clean sweep in the 2024 election, so they've gained control of the House, the Senate, and the White House. And this is set to bring some significant changes to tax policy in 2025. So for business owners, that's going to create some challenges. That's going to create some opportunities. But most critically, there's some tax planning considerations that business owners need to have as the conversation evolves. Look, it is a big win, but one thing I want to remind everyone is there were a lot of campaign promises that were made by Trump. And bipartisanship actually is still needed, and here's why. The Senate, so when you're thinking about the Congress, there's two chambers in the House. You've got the House and you've got the Senate. Now, the Senate requires 60 votes to advance legislation. Republicans only have 53. So it's still a very narrow majority. So that means that the moderates could potentially be a powerful broker in how things play out in the U.S. So they could yield some influence there. And the Democrats actually Democrats actually still have a role in this current configuration of Congress. But let's be very clear, Republicans still have a lot of control in the Congress right now. So what this shift does allow, it doesn't allow them to have that majority in the Senate, but what it does allow them to have is they actually can pass tax cuts. And the reason for that is in the Senate, you have this process called the budget reconciliation process. And what that does is it allows you to bypass the 60-vote filibuster, so the 60 vote we just talked about, threshold. Again, they'll still need to balance their own internal party views and, of course, the practical budget constraints that come from that. Now, of course, the other big buzz news you've been hearing this week, and I know, Shondell, you're going to talk about it, is tariffs. The interesting thing about tariffs is you actually don't have to go through Congress to pass tariffs. So we've already heard Trump talking about a tariff for Canada and for Mexico, but we really don't know yet what are the products and what are the actual timing for these tariffs. What we do know, just historically, is Trump is going to center his tariffs policy around how it promotes domestic manufacturing, onshoring, economic security, but there's still hurdles for the administration to prove how the tariffs are going to be a true revenue raiser. And here's why. And this is the part where, honestly, this tax geek gets really excited. The Congress has to deal with a bunch of tax provisions from the last big tax reform. in 2017. And a lot of those provisions, which impact mostly individuals, but they also impact multinationals, a lot of those provisions are temporary, and a lot of them are going to expire in 2025. So Congress has to deal with, how do we deal with these expiring provisions with all these other campaign promises? And with that, Chris, it's you.
Awesome. All right, so we'll switch to the panel, and I think that's probably the right time to go back to you, Shondell, with that tariff talk and what does it mean? You know, and we talked. Namir briefly talked about 2017 tax reform, where it was "Make America Great Again," the slogan that was used throughout the election in 2017, and. Namir uses the word excited. I use the word PTSD from 2017 when tax law was passed and put forward, passed, talked about, and implemented within 7 weeks, which is record-breaking in any country. And it was a complete reform. And I know it left us as professionals, both legal and tax, scrambling over Christmas to try and restructure things quickly so that people weren't double taxed. And so, I think you use the word excited, I use the word PTSD, because I'm a little bit worried about what's going to come and what our Christmas in 2025 is going to look like once this happens. And so I think when we talk about the tariff, Shondell, and this concept of reshoring, if you will, and that poses the challenges that it might pose, what do you think would create the opportunities for Canadian businesses to integrate into those U.S. supply chains and ensuring that we're still able to take advantage?
Well, it's individual for each business, but globally, and I'll use the most recent announcement of the 25% tariff, I think for sure it instilled fear in everybody. But if you look at what the motivation was and the timing, Donald Trump's all about shock and awe. But there's a message in what he's said. He basically has said, here's the problem, and here's my solution. And he points the finger back at Canada and Mexico to solve a problem for him. So we have 2 months, I think roughly, I think he takes office on January 20th, to come up with a plan. And it may be that he's acceptable of the plan and there is no tariff. But the message I think that he's sending to the world is he will use tariffs because he can at every step of the way. So for each of us in our individual businesses, it may have no impact. If you're making widgets and you're selling them in Edmonton, Calgary, Winnipeg, and Vancouver, it's likely not an issue. But if you are looking at moving to the U.S., it's a little bit of an unknown. But you do have to, I think, ask the questions and have a strategy for it. And I never like to say encourage people to go to the U.S., but if it's a big market for you, it's worth your time to have conversations with all of your professionals and develop a strategy for perhaps a move to the U.S. And of course, tax being one of the considerations. How do we do it? And it could be something as simple as, well, let's form a JV with somebody down there. And then you have, all the transfer price issues. But to say this, so he's added that there's another level of complexity. It's not just the tariff, it's the items that my colleagues here have been dealing with probably since they started in the business. Tax is just one of the components. So the added complexity is the tariff itself. We don't know what it's going to look like, but it's pretty safe to say that if you're selling into the U.S., at some point over the next 4 years, there's going to be a threat. But the motivation, it's not to be punitive. The motivation is, I want you down here making it. And it's a relatively easy problem to solve, because setting up in the U.S., other than the excitement of the taxes, is that there are areas in the U.S. It's a relatively easy place to go to do business. There's nobody better than Canadians to do it. We're the closest neighbor. We're their friends. We're allies. We're not a threat to them. So we actually have a bit of an advantage in setting up in the U.S. So there's no, I don't see it as being fearful. I see it as perhaps an opportunity to expand my market and maybe find a place in the world where I can do business a little bit cheaper.
Yeah, awesome. I think, at the end of the day, and you brought up a couple points in there, Shondell, with it is a matter, it's something's going to happen. If we know anything about 2017, something big is going to happen. What it looks like, what it applies to, I mean, it all speculative at this point, and it's gossip in this point, I think. But something definitely will occur in the next year.
Just to add something there on the tariffs too, on my earlier point about Pillar 2, again, not to dive fully back into tax yet here, but even with that, I mean, the way a lot of countries have responded to it, they said, well, we're going to implement some minimum tax for corporations that are doing business in our country. So when you think about the headlines, like 5 years ago, those big companies that they found out their tax bill was zero and not paying taxes anywhere, but they're making millions. That's how this has showed up. But the Republican administration is not keen to implement those type of minimum taxes. They instead would rather reciprocate with these type of tariffs, essentially targeting foreign companies, and especially targeting those companies that are from countries that are implementing that minimum tax. It's another level in there too.
Krista, from the Canadian side, I agree with what is being said. But strictly from the Canadian side, one thing just to add to what Shondell said, it's definitely an opportunity. Depending on certain businesses, every case is different. If you can move to the U.S., if you don't have the case to move to the U.S., we have to find a way as Canadian politicians. I'm happy that Mr. Prime Minister is meeting all the premiers. Alberta Premier has been visiting the U.S. regularly to build those relationships with the US, but at the same time come up with the comparative advantage that Canada can have. I'm not talking about economic comparative advantage. If they can work together and bridge that polarization there and come up with more pragmatic governance where we can reduce the taxes or create more space for innovation within Canada. Because this tariff threat can become regular. Every 8 years, as Shondell said, they want to solve a problem they can't solve, they will just give a threat of tariff to Canadians, and Canadians have to solve it. So we have to make Canadian economy stronger, develop the political comparative advantages that will help Canadians to diversify, as well as bring more bargaining power to the table. And at the end of the day, Trump loves to make deals, so hopefully we can make the deals, but prepare internally, that's the key part. And that's where Canada can become a stronger economy as well. Go CFL.
I think, what I see right now happening with some of our clientele is they're busy setting up U.S. corporations and getting equipment shipped now and getting it down into the U.S. versus before it would come back and forth a lot more frequently. Or just, let's move it down there. We'll create a transfer pricing agreement, as Shondell brought up, to lease it back to we pay the lease on it and whatnot. So some of the things around that is, planning ahead of time. What do I need to get done in the next 12 months in order to maybe deter some of that tariffs taking place? So Shondell, Atif, moving on over to you. We talk about, okay, now we've moved down to the United States and we have to worry about all this transfer pricing, and maybe we have tariffs that are applying, but then we want to get some money back to Canada, and we have to plan for that repatriation of those funds into the Canadian entity or back into the shareholder. What are some things you need to contemplate and think about when you want to bring money back?
So as I said, I touched upon it briefly, that first the end game is to calculate those tax pools. So when you set up a U.S. corporation, the U.S. corporations should be calculating those tax pools every year. If you have 5 corporations have to calculate their respective tax pools every year. And you have to make sure that if you're running active business income, most likely your biggest pool will be the exempt surplus, as they call it in the Canadian Income Tax Act. And if your pool, so that represents the Canadian, the active business income that you earned in the U.S. with some adjustments. it can get very, very complicated. But if you have an active business income there, most likely you have substantial exempt surplus. And you can bring, if you have an exempt surplus pool of $1 million or $20 million after 5 years, if you bring if you want to repatriate $20 million back to Canada, there would be a U.S. withholding tax. But on your Canadian tax return, you will include that, the Canadian company's tax return, you will include that $20 million and get a full deduction of $20 million. So be aware of that if you can proactively calculate that pool, because the CRA last couple of years has come up with this bigger form, T1134, 9 pages, and what it says is that if you report dividend on that form that was paid in that particular year, you have to attach the calculations. So if it's December 20, today's November 28th, and you want to pay a dividend from the US company to the Canadian company, and you call your tax professional, hey, I want to bring $20 million back to Canada. What is the tax implication? Well, how long have the corporation been around? 10 years. Well, we need your financial statements and tax returns for the last 10 years to calculate your pool every year. And that can take, as I said, it can get complicated. That can take a lot of time. That can take months. So you have to be proactively thinking about these things. When are you thinking of bringing the dividend back? Plan ahead. I mean, there are back of the envelope calculations that can be done, but they're very fraught with risks.
Actually, I have a question.
Yes.
The withholding taxes, is it a fixed rate or does it depend on the type of income, and is there a sliding scale?
So this is from the U.S. perspective. Namir, you want to take that? But generally, it's 5% because the treaty reduces it.
If to a business.
Yes.
Yeah.
Yes.
Yeah, if to an individual, 15%.
This is where you want to also rely on the U.S.-Canada treaty to give you those favorable rates.
To bring it to 5%, if depending on the ownership.
Well, you know, it's interesting. You just brought up a point there about the tax treaty. So a lot of people nowadays, we think AI and Google have all the answers. However, you need to be very careful because the treaty supersedes domestic law. And so a lot of times when you're looking online, you'll find the domestic law, which is great. However, that's only, I would say 30% of the story, maybe even 20% of the story, because it might be that there's a provision in the tax treaty between the two countries that completely overrides the rule. So if you were to look online, the U.S. is going to say you're withholding 30%. And that is actually not the case when you're dealing with a treaty country. So
the other part to be mindful of, and yes, I do get excited about this too, is the character of the income isn't always black and white in today's world. So when you're dealing with a digital product or a digital service, you may have even invoiced a client and said, hey, we're delivering this product for you, or we're providing the service to you. But the characterization of that product or that service is going to have pretty profound and different implications in how you're interpreting it for the U.S.-Canada treaty. And that's at the federal level. And then when you go down to the other 13,000 jurisdictions, so let's say you go to the state level, they will have, even just among the 50 states, different ways of defining and characterizing. Sorry? Yeah, it is. It is backwards. And so you really have to drill down to the level details. Even if you think you have the right answer for California, Minnesota might come back and say, actually, we don't see it this way. Here's some more questions you need to drill through.
yeah, that's right, exactly.
Krista, can I say something about the treaty? So I came across something interesting when NAFTA was renegotiated and they came up with USMCA. I always struggle with that abbreviation. IRS had to make a statement, if I remember, I was reading that it will not impact the treaty, which was good, but that made me wonder when the NAFTA is reopened, UMCA is reopened in 2026, how would the treaty play into that? So just putting it out there.
Awesome, yeah. So, Namir, I have a great idea. I'm going to move my business down to the United States. What should I do or not do when expanding down into the U.S. when it comes to structuring?
Well, there's a couple of things you want to think about when you're structuring your business into the U.S. I mean, primarily you want to understand what is the level of activity you want to be involved in the U.S. And the reason I say that is often when businesses are talking about getting access to this bigger market, and it's exciting because you're talking about California, you're talking about New York, you're talking about Texas. These are bigger capital markets that you have access to. As a business owner, that is where you should be focused on. You should be excited about how to grow your business. The tax implications that are going to come into play will be driven by what is not only your plan today, but you actually need to really be thinking about where do you want to be in 5 years, and actually more critically, what's your final exit plan? What's your final exit strategy? Like, is this business a wealth generation vehicle for you? Are you planning to use this as a business that you're going to hopefully succession plan for your children, your grandchildren? What is your exit strategy? And so it's really funny when companies come to us and they say, hey, I want to expand into the US. I Googled this model for a structure that might work. What are your thoughts? And they'll find out I'm not asking just about today. I want to find out, where do you want to be when you exit this plan? And sometimes it's even, how much do you like Canada's weather? Are you happy with the weather here? Because, if you want to go somewhere sunny in a few years, guess what? That's going to impact how you structure your business. Now that being said, there are some things where the election outcome also has an impact here. So one of them is in the original Trump tax reform, the one that happened in 2017, there was a provision that was provided for flow-through entities, so pass-through entities. And so that could be a partnership, that could be, for example, an S corporation, sole proprietorship. But what it did is it incentivized individuals that have those type of business structures to get a 20% deduction. So it's essentially a deduction on their qualified business income if they're set up that way. That's great. But guess what? That is, because it was in the 2017 tax reform, it is temporary. So that is set to expire. And so there's interesting opportunities there where a business owner might look at that and say, okay, we know that the Republicans have a slim majority. We think this is going to get extended because it would be a great thing to extend for any business owner that wants to get that 20% deduction. What if they don't? So they may want to look at options to convert to a C corporation before the expiration of that deduction when they're doing business in the U.S. And by the way, one of the biggest changes with the Trump tax reform in 2017 was taking the U.S. corporate tax rate from what was 35% down to a flat 21%. And that, by the way, that was a big change. And one of the reasons for that is it actually allowed the U.S. to be competitive on the international market on what is a good rate to have. And the reason I'm bringing that up too is actually that's one of the provisions from the tax reform that's not set to expire. So if there's some uncertainty whether we're going to get this 20% deduction or not in a flow-through structure, I would say the C corporation rate is not going to go up. In fact, there's some buzz around domestic manufacturers getting an even lower rate of 15%.
Awesome. And the one thing to avoid is
LLCs.
LLCs.
Well, I'll tell you. Let me just add one.
You don't have to avoid them, but
the thing with LLCs to think about is here's the deal. You go to a small shop in somewhere in the U.S. This is not me criticizing the small shop, but they're going to give you great tax advice for a U.S. owner on how to structure your business in the U.S. But you really need to be well versed on U.S. and Canadian laws to understand not only what are my U.S. implications, but what are my Canadian implications as well. And so the problem with those kind of quick, fast planning structures is they're not being mindful for what's important for the Alberta person or the Canadian owner. Now, if you're wanting to introduce other U.S. Partners to your business, maybe the LLC structure could work for you. But there's ways to plan around it so that you're not stuck with the adverse tax consequences, which could be double taxation for the Canadian owner. But there are ways to plan around it.
yeah, that's right. So, in essence, an LLC is what's called a hybrid entity, and I'll bring up the ULC in a little bit here in Canada. The majority of people down in the U.S. want to use an LLC. That is the most common vehicle that's used down there. And as you said, there's ways to structure it to use it so you can allow that injection of capital from U.S. investors down in the United States, but you have to create a structured tier in order to protect yourself from double taxation. Because it's a hybrid, Canada views it as a corporation and the U.S. views it as a flow-through if you do not check the box. And so by having that, you're taxed two different ways, which can create issues. And I know, you can say something else?
I was just going to say, the U.S. is really fascinating with this, right? Because these entity types are set up at the state level, And they have a lot of fun with this, because then they say, oh, let's make this hybrid structure that acts like a corporation, but has its flow-through status for tax purposes. And then they say, oh, we could do this with partnerships too. We could do limited partnerships, LLP or LLLP, and keeps going, add another L to that P. And Canada looks at that and says, this is quacking like a duck, it's acting like a duck, I don't like this. We're not going to treat this like a partnership for the LLP or the LLLP. And so they say, hey, you know what, this is also a hybrid entity, and it will also have adverse tax consequences. So you do need to be careful with those hybrid structures, which are phenomenal for U.S. owners, maybe not so great for Canadians.
Yeah, so stick to one L. Anything with more than one L, talk to somebody. Shondell, I know Atif briefly mentioned the USMCA, and that is another thing that's actually up for review coming soon. What steps do you think individuals or businesses should take to prepare for any possible changes that might come through, and how can businesses potentially influence what's going to happen there?
Yeah, well, first of all, I'll just go back to the tariff issue. The first response is fear. Then you take a breath and you might sit back and say, well, I'll get protection under the USMCA. And that's, could be true, but the process in order to get any kind of remedy when you go to arbitration can take a year. If you're really lucky and it's a big case and it's a headline case, you might be able to get resolution 6 to 9 months. But much like fighting anything, it takes time, and the process just has to unfold. So it's a year to get any kind of resolution. So let's say the worst happens, Trump says 25% tariff, everyone throws their arm up and say you can't do that, it's against the USMCA, and he says, no, I'm doing it anyways. And then everybody starts to fight. Now by that time, of course, it expires. So if it was me, I'd prepare for the worst, and which will likely be he's going to want to tear it up. And what does that mean? Well, it means that, again, he wants the same thing that he does with tariffs. If you're making something and you're selling it to our citizens, I want you to make it here. So however that looks, in a renegotiated USMCA is probably the most likely outcome. Now, again, it's not a given. It might not change at all, but I would suggest that you prepare by assuming the worst, making a plan, and look to execute, or look to think about executing that in the next year or two. That's been the history of Donald Trump. So, and it's the same. He wants you making your stuff down there. It's a bit of a bet. Historically, tariffs haven't worked. But his thinking, I think, is if I could onshore all of this manufacturing, I think I can make it work. The economy, instead of it growing at 2, 3, 4%, might grow at 6, 7, 8. That offsets the tariffs, and I end up being a winner. So I think that's what he's thinking in the back of his mind, although it's difficult to say. But you got to manufacture in the U.S. if you're selling to U.S. customers.
Yeah, it's interesting because if you truly step back and get rid of the fear, as you said, and think about what does this mean? So he wants to reshore everything, meaning they're going to need more labor, which they're already short labor, and then in the same breath he says, then we're going to kick 8 million people out of the country. And so when you're thinking about expanding into the U.S., and we talked about it, you talked about it a bit at the beginning, that all of these things exist. However, you really need to be, when you're expanding down into the U.S., you need to be careful to think about, is there going to be manpower there? Let's say I decide to go into Texas, where there's a large population, potentially not there legally. What is that going to look like? Same with Florida, same with California. They're on borders, right? So you have to, is there going to be an impact to the labor force? We're going to have tariffs, everything's going to be onshored, meaning now people have to try and figure out how to build everything there when they don't have the manpower. So there's actually a lot of components when you're looking at the expansion. And I talked with someone this morning about manpower is a big thing down there. There is a shortage, similar to a lot of places. So Sorry, go
Well,
ahead.
you actually raise a good point, which is, obviously, reshoring it is a solution, but it's also a business strategy, right? And as part of your business strategy, talent acquisition really matters. So if you are, and that's part of your plan, and your plan might be, I've got 8 guys, or I got 8 people in the warehouse here. They've all expressed willingness to move to somewhere US in order to make our business grow. I'm going to do that. But that's part of your strategic plan as you decide to make a move like that.
Yeah, and then as Namir said, watch the structuring, so that
Yes.
as the immigration lawyers in the room will say, structuring matters for a visa as well. So
Sean, I'd like to add to this conversation. You were talking about assume there'll be something there. The magnitude, sorry, online. Thanks, Krista.
Sean, I'd like to add to the conversation. You mentioned assume some form of tariff will be in place. I hear the later discussion, no doubt. What I'm challenged with, not suggesting I have an answer, how do you reconcile the Republican platform of lowering the average cost of living for an American citizen as a consumer with the labor issue in the States, higher cost for manufacturing? So I'm not suggesting anyone has an answer, but I think it poses a real question: how much is bluster versus negotiation as it comes to tariffs?
Well, if you had the answer to that,
I'd be on stage.
you
want to come up? Huh?
well, you might be the president. That's a very good question. Historically, tariffs haven't worked because they've been inflationary, right? And his bet's a little bit different, which is I'm going to try and increase economic growth. I don't know how it plays out. I would suggest that, much like any threat, he's using that as his opening salvo for some kind of negotiation. And I don't know what that is, but I'm happy to have the discussion, because if we collectively can solve this problem, it's a massive opportunity for all of us.
To add to what Shondell is saying and to your point, and there's a lot of paradox in Trump's policies, talking about innovation, but at the same time, tariffs have been traditionally used to protect development of local industry. So that doesn't foster innovation when you are protected. Having said that, I was listening to this lobbyist, he's an economist, and he's arguing for tariffs. And I was trying to understand his logic, his perspective. And he was saying that there will be tough times, but eventually things will settle down. One of the problems, my background is economics and political science as well. One of the problems with economists is that they think in terms of equilibrium. I'm pretty sure you've heard of that word. They used that logic when the Great Depression was going on in the 1920s, and they came up with the idea of tariff to protect the economy, and tariffs went up across the globe, made the situation worse. And the argument was that eventually things will settle down to equilibrium. That's where John Keynes came in, the economist, and he said, yes, in the long term things will settle down, but in the long term we're all dead. So that's the economist logic. But when tying it back to what Shondell and Krista was saying, now think about that state which is going to be most affected. And that's what Namir was talking about, how Senate is 53 Republicans, 47 Democrats. Politically, Republicans and Democrats are like this. When it comes to their constituencies, they can easily fall out of line. Because the senators, they're not like Canadian system where MPs are answerable to Prime Minister Trudeau. The senators are independent. And if they feel they're going to lose the election next time, whether Republican or Democrat, because the constituency will lose jobs because of tariff, they're going to vote against the tariff.
Yeah. So just hopping on over to tax here for a second, Namir, I want to make sure we touch on this before we go to some questions about what are some of the key tax considerations people need to take into account when expanding down into the U.S., both from a business perspective and potentially exposure from the individual with global mobility.
I think, look, with the clean sweep that the Republicans have done, it's going to provide Republicans really with this opportunity to implement their tax agenda. I know there's a lot of campaign promises that were made. But there are some key provisions that I think cross-border businesses need to be mindful of going into 2025. We talked earlier about the pass-through deduction. So if you have a structure that's set up as a pass-through, as a flow-through, there's potential for that to expire. We'll see where that goes. The other thing is one of the changes that Biden implemented in his Inflation Reduction Act was around stock buyback. So when companies want to reward their shareholders, you could do it through a dividend, or you could just give them stock back. And he implemented a 1% tax on that. We might see that go away, which will be interesting, because if that happens, that'll incentivize companies to then start paying dividends instead of buying back their own stock. Now, again, this was more applicable for public companies that have over $1 million of their buying back of their own shares. There was some talk about capital gain, indexing capital gains for inflation. Really what that means is, you're taking your asset and you're indexing it based on its actual true valuation. So essentially pretty much wiping out the capital gains that you would recognize on that asset. That's a really expensive proposal, by the way. I don't see that happening. It would really help high income taxpayers. I don't see that being implemented. But again, it's something to be watching out for in 2025. The other big one that really impacts businesses is the 100% capital expensing. This is known as bonus depreciation. So what this was is, in 2017, there was a provision that changed, again, temporary, that allowed companies to go from 50% to 100% of capital expensing. So if you are a company that's capital investment heavy, you have property, plant, equipment, you're able to expense any of those purchases once you place them in service at 100%. Now, that 100% deduction has already been phasing down. What might change is this phasing down, where it's gone to 80%, 60% this year. This might continue getting phased down, or they may come back and say, hey, we're going to provide opportunities to allow for full expensing of it. The other one that's also making a lot of buzz and news in the U.S. is one of the provisions that's already gone forward, starting in 2022, is companies are not allowed to immediately deduct their research and development expenses. And so what that means, if you're research intensive, if you're in the life sciences industry, you are actually having to capitalize those costs. And if you're in the U.S., that means you're not going to recover them for another 5 years. If your research costs are actually outside of the U.S., if they're in Canada, if they're in Alberta, that means you're not recovering them for another 15 years. There's been a lot of pressure to change that, and it also impacts companies that are in that industry when they're thinking about, do I really want to be doing this R&D in the U.S. knowing I'm not going to recover my costs for another 5 years or 15 years if it's being done in Canada? We'll see. The administration has some pressure to really think about reversing some of these provisions, but it will impact your capital investment decisions. It will impact your operational expenses and the timing of your purchases. The other one, and I know you mentioned this, when you're structuring your business, it's really important to think about, how do I want to finance my business? And we talked earlier about whether it's going to be debt or equity. One of the provisions that also came from the 2017 tax reform is, you were able to deduct your interest expenses. There was a ratio you had to be mindful of before 2017. But what 2017 changed is they said, okay, we're going to allow you to deduct your interest expenses, but we're going to give you a 30% limitation up to your EBITDA. EBITDA is just earnings for interest, tax, depreciation, and amortization. So it means you can deduct your interest expenses if that's how you're financing your cross-border business, but there's a limitation. They then drop it's EBITDA, so they then drop the DA, so making it even more limited. So you're more restricted on how much interest expense you're allowed to take for your company. Again, there's conversations around whether that's going to be changed and is that going to be reversed. But if I'm a cross-border business and I'm thinking about how am I financing, expanding into the U.S., I'm going to be looking out for this, and that probably will impact how I'm financing my business and if that's the right way to support the business's growth.
Awesome. And I think the one other thing that you need to contemplate, as we talked about the rugby game, is every state is different. Income tax, sales tax, as well as local jurisdictions have their own laws. And so I think one of you talked about the 5-year long game. What's your plan? Are you planning to sell? Is it generational wealth? One of the biggest things that we see come up in a due diligence on a sale of a company who does business in the United States is misreporting of income to states for sales tax and income tax purposes. which creates a massive issue for sales. I've seen a lot of deals fall through because companies ignored. Far too often I hear, well, how are they going to catch me? I'm not that big of a person in the United States. Okay, so the government may not catch you, but when you try and go sell your company, are you willing to take that discount because you've completely ignored your obligations in the United States? And it's, in Canada, we don't have that many jurisdictions for sales tax, but there are extreme amount of jurisdictions. And I generally say the minute, this is a very generality, please don't quote me on this, if you make about $100,000 in a state, make sure you're looking into the details. And some states have a transaction limit, some states have a revenue limit, some states, they all have their different rules about when they're going to bring you into their reporting regimes, but that's one of the biggest things that when you're down there, if you want to pass a due diligence, you better be doing your sales and income tax by state.
Yeah, there was. You'll hear sometimes tax folks talking about a Wayfair case, which went all the way to the Supreme Court. What that did is it changed the rules of the game to match the economic realities of being in an e-commerce world. So even if you've never physically set foot in the state, if you have any sort of sufficient contacts with that state, and that could be through economic nexus, economic activity, you could be subject to not only filing in that state, but also an exposure of taxes in that state. The one other thing I just want to add, because this actually happened 2 years ago, there's a commission called the Multi-Tax State Commission, MTC. They set up these rules because they basically want to see different states doing business with each other. They don't want these states to put, these burdensome rules and all of a sudden prevent different states from doing business with each other. Well, these protections that are provided for sales of tangible goods, so product, isn't necessarily extended to Canadian companies. That's what we need to be mindful of. The other piece is their guidelines are, they've just expanded them to things, for example, if you have a chat on your website, so if you have an option for clients to just have a chat, ask some questions, they're going to say you've done sufficient contacts with our state because some customer in our state logged on and asked a question. If you post a job and that person is in that state and saw that job posting and responded to it, that could be sufficient contact for that. And one last thing I'll add there too is, the U.S.-Canada Treaty is great. It does provide protections for Canadian companies and U.S. companies that want to do cross-border business, but that is at the federal level. So a lot of states have looked at it and said, we're not adherent to this. We don't need to adopt the provisions of the U.S.-Canada Treaty. And so they will subject you to tax and a filing requirement, even if you have no taxes owing to the IRS.
Yeah, and the biggest one for that is California. They do not follow the income tax treaty between Canada and the United States. So even if you think you're protected, you may not be protected from California reporting, and they're probably one of the strictest as well as far as how little activity you need to have to be brought into their regime.
The other big change I'm seeing, and this just happened also in recent months, is states are being more aggressive in how they're portioning your income. So what that means is, I'll use Massachusetts as an example. They've gone to something like a 9% apportionment. And basically what that means is they're going to look at how much sales are going into that state and say, just based on that factor alone, we're going to portion more of your income to our state to tax. So a lot of states are going into the single sales sourcing and how they're apportioning income that they're pulling in. They're just looking for different ways to net companies to pay tax.
Yeah, I mean, it comes back to what I said at the beginning. Every jurisdiction is trying to figure out how to make money on the money that's leaving their jurisdiction. And so Canada's not alone. You brought up one thing about the digital, because I know the digital services tax in Canada was a big uproar, and we're going to impact things like that. The U.S. has been doing this for a number of years. There's a lot of states that already have this and has existed for a long time. So Canada is actually behind the game a little bit in this introduction of law. Yeah, it sucks, but it's part of it. I just want to briefly jump, go in the opposite direction, because as I mentioned at the beginning, contrary to popular belief, there is a lot of capital coming into Alberta, investment money coming into Alberta, and we see, especially I would say in the last 2 months, I have fielded, I don't even know how many calls of U.S. people wanting to move to Canada and renounce their U.S. citizenship. So Atif, to you, if you're a company in Canada and you're looking to get some capital, what's the best way, and Namir, I'll get you to answer from the US side afterwards, but if you're thinking about the Canadian side of things, how do you want to be structured in order to try and attract some money into your business?
Do you mean from the
Like a ULC corporation, like how is a US company, what's the best way from a Canadian perspective to have that money coming in?
Right. So if a U.S. company, let's say, is investing into Canada, as we talked earlier, that entity structure is the first question you should be asking. And one of the favorite, I'm not saying universally, but one of the favorite that I've seen is U.S. companies setting up ULC. And again, I think I'll let Namir speak on that. I understand the idea of LLC holding the shares of ULC is not a good idea. It should be C corporation or S corporation. Again, not my area. So I'll focus on the CFL part only here. So ULC is an unlimited liability corporation, meaning that it behaves like a partnership for U.S. Purposes and a corporation for Canadian purposes. So you would be filing the Canadian tax returns for ULC, but the money that you will make, it will flow through to the U.S. corporation, and they will be able to claim foreign tax credits. They can offset their income against losses more. There's more flexibility there. So ULC is a good option, depending on every situation is different, but ULC is one of the popular ones. The other one point that I would like to make is that when a U.S. company is acquiring a Canadian company, how you make an entry into Canada can save you a lot of taxes. If the U.S. company sets up an acquisition company and funds that acquisition company, they have now more puck in the Canadian acquisition company. Puck is similar concept like stated capital in corporate law. And then the acquisition company uses the funds to buy a Canadian company, the target co, and then they amalgamate. So what has happened here at the end of the day is that the U.S. company has a higher puck in the Canadian company, the amalco, and when the capital has to be taken back, the repatriation, the puck is now subject to Canadian withholding tax because it's just a return of capital. So that's one thing that is good. And the other thing is when you amalgamate the acquisition co and target co, you can bump the cost base of the non-depreciable property in the target co. So how you structure entry into Canada, that can save you a lot of taxes down the road.
Yeah, I think, I talked about the PTSD of 2017, and what I don't think the media really talked about a lot and common knowledge is why did Americans stop investing for a while? And a lot of it actually had to do with US law and not necessarily Canadian law, because it made it very punitive for US people and businesses to invest outside of their country. And so when you're talking about the structure of the ULC, one of the reasons it became the most popular was because you got a flow-through status instead of investing in a corporation. And I don't know if you want to touch briefly on U.S. companies owning Canadian companies, but it probably makes sense just to briefly talk about that, because it really was one of the main reasons that really hindered U.S. businesses from investing, not just in Canada, anywhere in the world, was the U.S. tax law that got implemented in 2017.
Yeah, so one of the, targets that the tax reform in 2017 was essentially trying to target were those companies, so those foreign subsidiaries, when I say foreign from a U.S. perspective, so any non-U.S. subsidiary for U.S. shareholders that were earning income, but they were holding those profits offshore. So they essentially, there are these two big provisions that came out of the tax reform, GILTI and FDII. And essentially what you need to know here is they were impacting multinational businesses. And
they were meant to impact
multinational businesses. And it was their best attempt to going to a more territory-focused approach in terms of how you're taxing companies. Now, what GILTI did is, it's got that unfortunate name, is enacted income inclusion for U.S. shareholders of foreign subsidiaries. Now, what's interesting about that is there is a tax that was set for those U.S. shareholders that's also set to increase that minimum tax for U.S. shareholders that own foreign subsidiaries. So that's another thing that multinationals are going to have to be looking for going forward. The other thing that they did too, though, was that they wanted to incentivize any domestic companies that were selling their products or services abroad. So if you have an IP, if you have intellectual property, they wanted you to onshore that to the US so that you're licensing whatever good or service you're then selling abroad. And so then they also, one of the other provisions from tax reform that impacted how you're structuring your business is they provide a lower preferential tax rate for those domestic companies, US companies that are selling their goods or services abroad. Now, that lower preferential tax rate is also subject to be going up as well. So another thing that multinational companies are going to be mindful of. And by the way, because we don't know where these things can go today, one planning opportunity for companies, if they are set up this way where they have it's a U.S. business with an Alberta subsidiary, is potentially streaming their income, accelerating their income now before these increased tax rates that are there for U.S. shareholders on those subsidiaries, or if you're a U.S. domestic manufacturer, potentially again accelerating that income before you lose that preferential tax rate.
Awesome. Yeah, I think at the end of the day, one of the most common ways U.S. people today is the unlimited liability corporation. However, you need to stack it to create liability protection. But you'll often hear a lot of investors from the U.S. looking to set those type of entities up in Canada to get access to the foreign tax credits and flow-through status like they would with an LLC, and get out of the deeming provisions that the income is deemed to be taxable to you even if you're not repatriating it when you're using an entity. Are there any questions? We have about 15 minutes left, so I just does anybody have any specific questions, or I'll keep going if you don't? Yeah, I'm going to use the microphone because it's online.
With this whirlwind happening in the United States and this potential tariff that's coming, I know it's on raw and on finished products from other countries, from Canada and Mexico right now, but what about services? What about professional services, which is the industry I'm in? I don't sell widgets, I sell my brain. So do you have anything to say about this services as opposed to products this morning?
Sorry, is it from a tariff perspective or income tax, or both?
Tariffs, I think that's yet to be seen. What Donald Trump said is, in his announcement, 25% tariff on everything. And so and again, undefined, but the interpretation would be that any foreigner who's selling a service or a widget will be subject to the tariff. But again, the details are fuzzy at best.
I would say it depends where you're providing the services as well, right? So if you're a professional services firm operating in Canada, you do not enter the United States, you are digitally providing those services, you're going to want to look at your digital taxes that exist and sales tax that exist. Typically, when you think about tariffs, it's when someone is physically crossing a border. However, as Shondell said, he said everything. So it's so undefined right now of what his everything means, but I wouldn't put it past him. However, I don't know how that administratively, when your IP address is in Canada, you're physically in Canada, all of that stuff is in Canada, how that's going to be administered. But it's, I would say, from an income tax perspective.
I don't think there's any specific target on professional services firm. What we do know is that what we can go off is at least Trump's policy previously has really been centered on onshoring, domestic manufacturing, and economic security. So I don't know potentially how that could violate those tenets for him, but that's what we can go from what happened in the first round.
Hi there. We bring in electronics from China, and to date we land everything in Canada, and then we distribute our products in the U.S. today. using Amazon, ShipBob, and different sources like that. We market our products through our website and through Amazon's website. And last year we set up a U.S. entity, but we haven't started using it yet. And we made that error that you talked about. We set up an LLC, so we have to now go through the process of changing it to something. So my first question is what do we change it to? You talked about a C Corp or an S Corp, and we're not sure which is the best way. When we bring in the products into Canada, we've just recently brought in a ton of product. And that was before we actually found out Trump won. So now we're wondering, do we take this product and just move it all to the U.S. right now, which would be easy for us to do. We can land it into distribution centers down there. Is that a good move, or can we take products from a Canadian entity and just move it into our U.S. entity without getting hit with tariffs? So the last part of this is none of the products that we bring in have ever been built in North America and probably never will. Will that stuff be tariffed as well?
I think for the structure that you're talking about, yeah, I'm glad you're considering getting out of the LLC structure. The right structure that's going to make sense for you. I mean, there's no quick answer for that. Some of it is going to depend on answering questions. Again, to what's your growth trajectory for the U.S. business? Where do you see this business going today, and where do you see it going in the next 5 years? Because that could also impact, depending on how it's structured right now, some of the Canadian tax benefits you get as a Canadian business owner for your Canadian entity. The other piece is going to be, what is your repatriation strategy? What I mean by that is, what are your immediate cash needs today for as a business owner or as a Canadian entity? Or are you planning to retain a lot of those profits in the U.S. because this is the beginning of something of a bigger footprint for you in the U.S. And so this could be a way to retain those profits, keep it at a better tax rate today in the U.S. And reinvest those profits in the U.S. So those are the different questions that will come into play, as well as are you looking to add other partners to your business in the U.S. or in Canada? All those different variables will drive what's going to be the best answer for you.
I was just going to say the shareholding part of that too. I think we briefly talked on it about taking Canadian corporations for purpose of your capital gains exemption. Should you ever choose to sell it, you'll want to make sure to keep kind of the U.S. operations in sister companies versus parent subtype of entities, because if the value of your Canadian company becomes a majority from U.S. operations, you could potentially taint it for purposes of accessing your capital gains exemption, which is tax-free money in Canada. So it's another, because unfortunately there's not kind of just this is one answer, but C corporation is, to answer your question, one of the general ones.
Yeah, and tax considerations aside, the business risk for your product has grown exponentially. Trump has been very clear that it's not, he wants to reshore, but he wants to stop Mexico and Canada from importing Chinese goods and then selling them into the U.S. So and again, the answer might be we're not going to do anything, but it's an exercise worth going through. If, depending on the impact to your revenue, that, okay, well, can we sustain a 25% tariff if this happens? And if it's a low risk move, ship the product south and see what happens.
Just one small reminder too is, the border is invisible to our naked eye, but you got to also make sure when you are transferring any of those assets between those related companies as well, that you're also using some economic pricing methodology as well to make sure so that it's not going to be subject to the CRA or the IRS scrutiny.
Hi guys. Question for you, Kristen. I'm sorry, it's a very uninformed question, but I don't think that I appreciated that individual states could effectively, circumvent or opt out of the federal level treaty. Could you explain how that works?
I'll let Namir go.
Sure. Yeah. So the U.S.-Canada income, it's called Income Tax Convention, the treaty. Now the signatories to that are the U.S. government and the Canadian government. But the way the United States works is each of the different 50 states They're their own political entities in the sense that they could say we're not signers to this. We are. It's not binding for us. Now, some states have gone out of their way and expressly said we are adopting the provisions of the U.S.-Canada Treaty, but that's a minority few. Funny enough, but not surprising, a lot of the states that are on the border with Canada are ones that are not signatories to the U.S.-Canada Treaty because they know that that's a way for them to be able to, basically get taxes on Canadian entities. And just from a, interesting tidbit from a politics perspective, if I'm a state and I'm taxing a non-U.S. person, they're not my constituents. They're not going to affect me maintaining my voting position or my political spot. So I'm going to tax a Canadian, right? So from their perspective, it's a win-win. They get to tax a company that's in Canada. The only thing about it here too is it leveled the playing field for a place. Let's say I'm just using Minnesota as an example. They had a brick and mortar store that was selling and being taxed, and then you have this Canadian company that is able to deliver the same product or the same service, but the U.S.-Canada Treaty tells you you're not going to get taxed. The states said, well, wait a second, they're going to push this Minnesota business out to the street. I'm going to tax this non-U.S. entity. So there's reasons for it. There's ways now. You don't immediately get taxed just by doing business in the state. You actually still have a threshold. It's called nexus. It's a lower threshold than the treaty, which requires a permanent establishment. And nexus is a lower threshold, so you still need to reach that threshold to be subject to tax in that state. You need to have minimum contacts in that state to be subject to it.
Well, thanks everybody. We're around if you have questions. These three are around. I think if there's any key takeaways that I would ask you to keep in mind when you're doing that. One is CFL, NFL, and rugby. They're all different, and they all throw a ball, but they're all very different. If you're looking to have U.S. investors to come into Canada, they're probably not going to want the same structure you have. So when you're setting up your businesses and looking at that, contemplate what you want to do. And similarly, when you're expanding down to the U.S., think about your end game, as Namir said. What is your plan in 5-10 years? Are you trying to do sell this business, grow to sell, or are you trying to grow it to invest VC down in the U.S.? What is your goal? Because that's going to impact the type of structure that you're going to use. And the one thing that we didn't touch on at all very much was the individual. And so we've talked a lot about the business expansion, and we talked about the structure matters for purposes of immigration and what type of visa that you're going to get. If an individual is crossing a border, you too, as an individual, are subjected to U.S. reporting. And so even if you're going down there and working, say, 30 days of the month for your business down there, and it's your business and you're operating and you're doing a few days, you likely still even have a treaty reporting position, both Canada and the United States. Even if you are not subjected to income tax, you are required to disclose to both countries that you have used the treaty to protect your position from taxation. And if you do not file that, especially from a business perspective, the IRS has come out and said, well, if you don't file your treaty-based return, cool, we're going to tax you on your gross income and deny you expenses because you chose to ignore the provision. And so they can't, whether or not that's going to be enforceable under the treaty, yada, 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 that is what the IRS has come out and said, the U.S. tax law. So I call it an insurance policy to just file your treaty protection and say, I'm protected by the treaty under the different provisions of articles, both for an individual and a corporation. And going back to what Namir said, just because the treaty says you're not protected if you're in California filing a California return or any other return that doesn't follow the treaty, because you might have exposure. So thank you, everybody. Thanks online. Thanks for those that have, sorry. Yes. Oh, did I trigger a question?
So it brought to mind the W8 Benny.
W8 Ben, yeah.
Yeah.
W8 Ben E or whichever one.
I've been calling it the Benny. I don't know if that's correct, but if you've completed that with customers in the States, does that fall under the treaty exemption?
Yeah, so the way that form does, it actually doesn't get filed anywhere technically. It's essentially just sitting in your in that vendor or the client's desk or cabinet until they otherwise get audited. But what it does is it tells them whether they should be withholding for you or not and at what rate. So if you're protected by the U.S.-Canada Treaty, you would say, here's why I'm protected and here's the rate you should be. Either it's a lower preferential rate or no taxes at all. That's the objective of the W-8 Benny. And that also assumes when you're going the W-8 Benny route that you're a non-U.S. person. If you're a U.S. person, there would be a different withholding form. So there's a W-7, there's a W-9. So all those are used essentially, let them know what's the withholding rate to tax you at, if any.
I just want to say Canada actually has a similar form. It's just not mandated like the US. Well, it is, but it's not enforced, I guess, if you will, that if you want to reduce withholdings on a non-resident person, you should be getting a form from them to prove that they're not a resident of Canada. So Canada actually has a similar type of documentation that exists that because it's not enforced, nobody really uses it. You see it used a lot in artists and entertainment because they do enforce it a lot more, but it actually exists both ways, that type of documentation. And it's just to keep on hand to prove you don't have to withhold, not file with any authority. So thanks, everybody. And if you have any questions, let us know.